Hello, good afternoon. My name is CryptoCape, and today I want to discuss multiple time frame analysis, how we can analyze market structure on an higher time frame as well as on lower time frame, and how we can analyze market structure using supply and demand as an entry and exit strategy on both higher time frame and lower time frame. So when we talk about multiple time frames, what do we actually mean? What we mean by this is that multi, as in on a time frame that is more than one, you can choose to trade on just one time frame. But when you trade on that one time frame, like for example, like on this daily chart that I am currently on, you will have to find your market structure, identify the structure on the day, find your entry zone on the day, and also find your exit zone on the same time frame. But when it comes to multiple time frames, there are two approaches. We have the top-down approach and we also have the bottom-up approach. But the commonly used type of approach is a top-down approach because you start from a bigger time frame, like on a daily time frame, and you work your way down up to the maybe 1 hour or even 15 minutes or 5 minutes or even a minute time frame, in order to time your entry to have that perfect entry. That is why it is most preferable to use the top-down approach, because when you use the bottom-down approach, like we have on this chart, we have the market structure is bullish, right? If you haven't watched my lesson on market structure, I suggest that you do now. And also I have also a lesson analyzing market structure with supply and demand. I also suggest you watch that as well before continuing with this multiple time frame analysis using market structure and supply and demand. So as you can see, the structure is bullish, right? We have an high here, we have a low, higher high, higher low, and what we have here is also an higher high. So the market structure is bullish on this daily time frame. But let us look on the 1 hour and see what is happening there. Okay, here is the 1 hour chart. If we zoom in or zoom out, we can still see that the structure is bullish. But if we zoom out or zoom in, anyone, we can see on this particular zone here, this area here, from here to here, we can see that the structure is currently bearish, and that is because it is on a low time frame. We have a high there to a low, and lower high and a lower low. As you can see, it's bearish. So if you're trading from the bottom up approach, seeing this structure gives you a bearish bias. You want to believe that the market is currently bearish without considering what is happening on the higher time frame. And this can make you to short the market or sell whatever you have at any exit point on this hourly time frame, forgetting that where you are selling on the bigger time frame might be a place people are buying on the bigger time frame. And as we all know, bigger time frame take precedence over smaller time frames, because it is a lot of things that has been done, a lot of data that has been processed on that particular day that sums up to make up the bigger time frame, in this case the daily time frame. This hourly chart is showing us each candle here or each candle here, either a bearish or a bullish candle. Each one on the 1 hour time frame is the combination of data, both buy and sell orders, that has happened within the hour. Whereas going back to the daily time frame, each single candle here, either the bearish or the bullish candle, each one is a combination of all the market data, both buy and sell orders, that has transpired and happened within the whole day. This means A lot of sellers have come within the day, and a lot of buyers have come within a day. The number of buyers and the number of sellers that has transacted within the day will definitely be much higher than within the hour. Even though there are some times where some hours are they usually have more transactions than other hours, like some busy times, like peak times. But the day is a combination of all the hours in the day, so they take precedence over lower time frames due to the number of transactions that has taken place. So this is why you also want to use your approach as a top-down approach. Start from the higher time frame and work your way down to the lower time frame. Now, some people prefer to use 3 time frames. Like some people will like to watch on the daily, then watch on the 1 hour, and then take their entry. Watch on the 4 hour, then take their entry on the 1 hour or on the 15-minute time frame. As you can see on this 15 minutes, what you can see on this screen is pure bearish price action. Using the trend line, we can see it's purely bearish. So if you are trading on this lower time frame and working your way up, what your buyers will be bearish. Whereas on the bigger time frame, we can't even see the line here. It's from this side to this bottom. And looking at this structure on the higher time frame is bullish. So why some people choose to use 3 time frames in their multiple time frame analysis is so that if they use maybe it depends on the way you trade. If you are a scalper, definitely you trade within few minutes, you are out of the trade. You enter and within few minutes you are out of the trade. If you're a day trader, then you want to open your position, your trade within the day and close it also within the day. Like you open a trade in the morning and you close it in the evening. If you're a swing trader, you can open your trade for up to weeks, maybe a week or 2 weeks, even 3 weeks if you're a swing trader. Now, if you're a position trader, that is long-term investing. You can open your position for as many weeks or as many months as you want. So, choosing your time frame will depend on the type of trader that you are. But I personally will be focusing as a day trader, which means we might want to use the daily time frame, the 4-hour time frame, and either the 1 hour or the 15 minutes. This will solely depend on you, or even the 30 minutes to time your entry. So people want to use a daily time frame to see the structure, see the direction, so they can have a bias. Now, our bias using this daily time frame, our bias is bullish, right? As we have a bullish market structure, and using the trend line, you can do it like this using the close depending on you. You can also use the wicks, but both ways our structure is bullish. We are seeing an uptrend, right? Then you go to your 4-hour time frame. This is where some people wants to find their entry zones and exit zones. Like their bias is bullish, right? They know the coin is currently going up, so they want to find zones of possible reversals where the price may come down, retrace to, then reverse back and continue the bullish movement on the high time frame, because they do say you do not want to trade against the trend. Of course, you can trade against the trend, but you don't have to have high hopes when trading against the trend. So you can either find your entry zone and exit zones on the 4-hour, and then you go down to the 1 hour or the 15 minutes to perfect the entry. But what I personally do myself is I do use 2 time frames. I don't need 3 time frames. I watch on the daily. I trade supply and demand. So this is the last high before this higher high. I personally will want to rule that. It is also a pivot high or pivot high. And this is a last red candle leading to the break of this structure. Also, not just leading to the break, we have a good movement here, strong movement. Here is the base. This is not a supply and demand lesson, but I'll be using some terms I hope you understand. Very soon I will release a video on supply and demand. So in supply and demand, we have some different types to different filters to identify a zone. Here can be a zone, here can also be a zone. I will be taking this as my zone for the sake of this lesson. I'll be marking it as my demand. So this is on a daily, this is a daily time frame demand zone. So what I want to see is I want to see price retrace to it. I want to see price retrace to it on the day and then continue the upward movement. That is what I want to see. So if on the day the price is coming down to it, what I want to do now is go on to my 4-hour time frame to see exactly where the demand originated from. There are also 2 or 3 ways to take entries when you have a zone. You can wait for a confirmation of the trade. You want to be sure that the zone is not going to break. So you want to watch a lower time frame market structure, because as we can see on the 15 minutes chart, the market structure is bearish, right? We have an high here. We have an high, we have a low, a lower high, a lower low. I don't know if I can take this as a lower high yet. Let's use a Fibonacci from here to here. Okay, it's up to the 50% range, so it can be our lower high. But we are here to see a lower low. So I want to mark this low for continuation of bearish pattern on this 15 minutes time frame. So you can watch the pattern on the 15 minutes time frame. This is where I zone it, right? So I zoom it, continues downward, comes back up like this. Then it hits the zone. What are we willing to see? What should we be willing to see to know that the market is reversing? Like I said in the market structure class, I would like to see this last high leading to the break off or the continuation pattern and leading to a lower low. I want to see it broken. So some people will like also to see this high get taken out on the lower time frame of 15 minutes as it approaches the daily demand. So what they like to see is something like this. They want it to come back up, probably retest a bit and take out this high. Let me remove this and remove this. Now, once this high is taken out, there will be a demand either here or here, because we may not even have a retracement like this. We can have a straight move like this. And like I said, the last red candle to take out or cause a shift in market structure with a strong move is a demand, because this thing can actually come back and close below it, leaving a wick above. The structure is still broken, but not a strong one. So any demand you find around here or here might not be a strong one. So in case this high gets taken out, the last high leading to a break in structure or a continuation in structure and a break of this swing low, there must be a demand around here. So if the demand is still on top of this daily demand or somewhere in between, you want a retracement back to it. Since the structure has shifted to the upside from this down trade, then you want a retracement to that demand and a continuation to the upside. Now, if you can look at this, the market structure has broken here. You can see here people trading patterns. We see here as a left shoulder, here as a head, here as a right shoulder, in an inverse head and shoulder pattern. So once they to see this eye, here will be their neckline. This will be their neckline. So once they see this neckline broken here, they now are trying to buy on the retracement, or they are even buying on the breakout of this neckline. That is for pattern traders. But you as a supply demand trader, once you see this eye, last eye on the lower time frame, as it approaches the daily demand and it gets taken out here, then you want to find the demand on the 15 minutes time frame. It can be also on the 4 hour. The same thing can happen on the 4 hour. The same thing can happen on the 4 hour, on the 1 hour time frame. You are looking for the same pattern. But like I said, there are several ways to trade. There are several ways to trade, to take an entry. This is one of the confirmation entry, where you want to see a full reversal before you take the trade. Sorry for I'm trying to remove. Okay, let me just, I have to redraw the zone on the daily. Okay, so it is a daily zone. Then going back to the 4 hour now, this is a pivot eye, and once this eye breaks, it's still a mini structure, right? It's still a mini structure. We have this high, we have this low, we have this high. It breaks. This is on the 4 hour. It breaks now from this side. Assuming it breaks, then comes back making a lower high, then a lower low into the daily demand. This is not a 4 hour demand now, even though there is a demand also here on the 4 hour. But I'm still talking about the confirmation entry. Now, what you want to see using this method of entry is you want to see price bounce from this daily demand on the 4 hour, take out this last high leading to the lower low, breaking this low on the 4 hour. Then the demand zone that does that breaks this high, is where you want to put your entry. So assuming there is a demand around there, or it can even be here, then you want to take the entry since you have seen this high broken and anticipate further up movement. You see, it's the same thing as on the 15 minutes time frame, but the 15 minutes time frame will ensure that you take the trade quicker and faster with less time, less waiting time than on the 4 hour. One candle is 4 hour here, while one candle on the 15 minutes is just 15 minutes, right? That means you can easily see the quick break. If a break is going, if a reversal is going to happen on the higher time frame, it's going to start from the lower time frame. So you using the 15 minutes will give you a quicker entry than the 1 hour or the 4 hour. But you are still trading the daily time frame zone, so you want your exit target to also be a daily time frame exit. Now that is one way you can enter on multiple time frame analysis using a break of structure. Another one is break of trend line, because trend line is also to see the trend, to see the structure. So let's assume, let's go back to the 4 hour. So let's assume again, we have this side to this, let's say to here, back here, and into here. Now, seeing this type of formation on the 4 hour, it is a daily demand, right? Then you want to take your trend line and roll this. So instead of waiting for the break of this last high, as it is or with market structure, you are waiting for the break of this trend line. The break of this trend line should also lead to the break of this structure, but in some cases it won't. So you are waiting to see the break of this trend line. Then you want to find a demand that breaks this trend line. So when you get a pullback to it, like they do say, once a retest of the trend line, you are longing it. Since you know the market is ready to shift to the upside, then you anticipate for the higher movement. This you can also do on the 15 minutes or the 1 hour time frame using the daily demand. You can also find your demand zone on the 4 hour. Like I said, we do have a demand zone here. And then you go down to either 1 hour to find this same pattern, or even the 15 minutes to find this same pattern. You want to see the pattern reoccur. You want to see it coming up, coming down into the demand, and then breaking the trend line on the 15 minutes. Once that is done, then you look for the demand that broke the trend line or that breaks the high of the structure, leading to a shift in market structure, and you want to trade it on retest. That is giving you confirmation that the market is ready to turn bullish. It is better than putting your order on this demand zone. It is a blind order because you do not know if the oncoming traffic, as in the oncoming trend, will lead to a break of the demand, which will then trigger your stop loss and cause you some losses. So when you trade with confirmation, you are seeing that yes, the market is ready to go back up, then you take the trade. The disadvantage of trading with confirmation is that sometimes you will be expecting the market to do this. Comes into the daily demand, breaks either the trend line or breaks a structural high, retest, and run off. And then you will be buying on this retest, right? You will be buying, we need to buy on this retest. But sometimes what the market does is not like this. The market will just come up, as in the market will come down to the demand, the daily demand. You are watching on the 4 hour, the 1 hour, or even 15 minutes. But then what will happen is once the price comes into the demand, just touch the tip, what you see is a run up with no retest. This will happen a lot, but it's more safer to trade with confirmation than trade blindly, because you do not know when and if the market will just do something like this and break the structure or the demand, and then you end up losing some money. So that is the main purpose of using multiple time frame analysis, to time your entry. Because if you want to see this break of structure on the daily chart, and remember, like I said, the daily chart combines 24 hourly candles, right? That means if this candle were to be here on top of the demand as a retest, like this, there are many market structure in this particular candle, like I've showed you on the 15 minutes and on the, like this. Let me use the 15 minutes now. Like this. Okay, let me just use this. You see this price action? You see this price action? You are seeing a structure, right? And once this side breaks or this side breaks, you know the market is going back up. But look at it on the daily. It's all within this bearish candle. All within this bearish candle. So when you are waiting to watch for structural break on this daily time frame, you'll be waiting for days before you can take your entry with confirmation on the daily. That is why it is essential to go into the lower time frame and see the break of structure or any reversal pattern that you trade. Also, there are many more ways to still trade confirmation than the two I have mentioned. There are many other ways. You have the zone taking out a zone. Like you have the daily demand. You've gone into your 4 hour. Like I said, this is a low on a mini time frame. Now, assuming we have a red candle coming straight down like this. This last green will be our supply, right? So that will be the supply. On the 4 hour supply, breaking this is low, coming into a daily demand. Because this is a daily demand, you want it to take out this bearish supply, right? So on the 4 hour, right? So when you see something coming back up from this demand and taking out this supply on the 4 hour, for the supply to be taken out, that means there must be a demand in between all this price action. So you want a retest of that demand, wherever it may be, and then you are trading it entry and anticipating the continuation of the move upside. So that is basically the essence of trading multiple time frame analysis. Is used to time yourself and time your entry, so you can have a low risk and higher probability trade. There are many ways on confirmation entry, but this is not a course on confirmation entry or on blind entry, but it is on how you can use multiple time frame analysis. Let me see if I can get one more example. Okay, let's use this. So this has supply zone, I think. Yeah, resisted. Just with a break. Okay, yeah, it's another form of demand. I mean supply. Okay. So what we see here is a bearish market structure on the day, right? We have this high to this low, to this lower high, to this lower low. That is a bearish market structure. Then this is the retest, the lower high of this move, and we anticipated a lower low, but it didn't come before this zone gets taken out completely. It was stripped here. That means for this to be stripped, there is a demand just below it. It was stripped on this red candle, but I wouldn't use this candle because the price action on it is not good. So you go to the lower one. So there is a demand here, comes back to it, retested like 2 or 3 times before completely breaking this one, then testing this upper supply, coming back down a bit, and then breaking it completely. So if we were to trade this, either of this supply on the daily time frame, let's see our 4 hour if we get any confirmation entry, assuming we were to be trading it live. Okay, let me go back and use the replay. Let's try this as it just approaches it. Okay, so let's go to the 4 hour. It is a daily zone, right? Okay, so what do we see now? We see this up move, this low, then this leading to higher high than this. Let me mark it. We have this move, this strong move up, then this retracement, then this one leading to an higher high than this, right? So let's mark this side. For this side to be taken out by this side, that means this low is a swing low, right? It has led to the shift in structure, mini structure, right? So what do we want to see? Like I said, when we are trading with market structure, we want to see this low. We want to see this low broken for our buyers to be bearish as the price approached Oh, sorry. We want to see how this to break so our buyers can remain bearish, and then we can find the supply breaking this low. Okay, let's see what happens. Okay, now we get the break of this, right? Now, this is the last low leading to this high, which is higher than this. And now the high is broken. So what do we want to do? We want to look for the demand. I mean the supply, sorry, that breaks this. Now, like I said, the last green that breaks this is also a pivot. Another pivot is here. So where is the last green? I think it's just this minute one. But because there is a lot of price action here, you may just use this. So now your buyers have been confirmed to be bearish. This daily zone, this daily supply is holding to be bearish. So you want a retest of this. This is where you are now placing your entry because you are sure once price comes back into it, it will continue to the downside. Let's see if that happens. Can you see the reason why I said at times it's just touch and go? Now, trading confirmation, we are waiting here for a retest. But it's been, since they pull away from it, it's been how many hours or days now? It's been 8 days and we will still be waiting at this point. Just because the price came into this daily zone, trips it a bit, and then runs off. We are waiting for a retest because we are trading confirmation and we are not getting it on the 4 hour. It's a daily zone. We are waiting on the confirmation on the 4 hour. So in order for this not to happen, you can go. Let me see. I think we have the retest now. Okay, yeah. After how many days? After 10 days is when we get a retest. And now, this zone might not be a good one anymore. It might not be a good zone anymore because trading supply and demand, you have some number of days you want to wait at a zone to remain for it to remain valid. So let's see what happens, if it still holds or not. Okay, seems it's still holding. Okay, seems it's still holding. And now it's broken. It's stripped. Now it has been stopped on side again, and now it's coming down. So you see the disadvantage of confirmation entry at times. You are trading this zone on the daily. You have decided to watch for the structure or a confirmation on the 4 hour. Now this will be your confirmation. The moment it broke down, it's showing you that here now is a good supply for you to trade. And now it took a lot of days. Okay, let me just see the breakdown. It took 9 days, 20 hours, almost 10 days before it got retested, and then came back a bit, and then comes back up to trip it. If you have your tight stop just above this, you might have been taking out if you haven't taken profit here. And watch this. This is also an eye, a pivot eye, a swing eye, and this here should be a demand. Probably where this one found the demand to break this side. So you see the disadvantage of at times waiting for confirmation entry. But in order to avoid this long wait, you might choose to go and wait on the 15-minute time frame because that is quicker. So you can get taken into the trade quicker, just the same way you can get taken out quicker. Any demand you see here is not holding because the market is bearish, running off from a daily bearish structure or a daily supply zone. As you can see, we have here. So the next move, I think it got taken out. So that is how you can trade multiple time frame analysis. You are looking for your buyers on the time frame, then you move to another lower one to find your demand or your entry zone, and you are moving to the next lower one to time your entry. I think I will continue this topic when I talk about confirmation entry and limited, when I delve deeper into supply and demand, because there is no way we trade that without going into multiple time frame analysis. This is just like an intro into multiple time frame analysis. If there is any part you haven't understood in this video, please kindly let me know so I can touch it again. Thank you.